Federation of Credit and our technology partner, Credit2B. I'm Justin Warden, the marketing coordinator, and I'm here with Ken Frisco, the operating board director of the Federation of Credit, as well as Matthew Piniella of JP Morgan, who will be doing the presentation today on an overview of the bankruptcy claims market. Just a few items I want to get out of the way before we begin. If you do have any questions during the course of the presentation, you can feel free to put them into the chat or questions functions on your side panel, and I'll pose them to Matt during our Q&A at the end of the presentation. We also do have a brief survey that will pop up when you exit the webinar. It takes about 20 to 30 seconds to fill out, but it gives us a lot of great insight into how we can continue to improve our webinars. One other thing that I know a lot of people do often ask about is getting a copy of the presentation slides. So once the webinar is finished, we will be following up with everyone who is on the webinar today and giving you guys a copy of those slides. So with that, I'm going to pass it over to Ken so he can introduce Matt and begin the presentation.
Thanks, Justin. Good morning or good afternoon, everybody. Just a little background on Matt. He's a vice president within the North American Credit Trading Group at JP Morgan, where he has executed transactions involving billions of dollars in various types of bankruptcy claims and other distressed assets. Before joining JP Morgan, Matt helped develop the bankruptcy claims market at Second Market Incorporated. He holds a BS in Business Administration from the University of Richmond and is currently completing his MBA at Columbia Business School. Matt has both his Series 7 and 63 security licenses. So some of the things you'll hear Matt address today on claims trading, claims agreements are how bankruptcy claims are created, who are the typical participants in the market for bankruptcy claims, what sort of agreement is used to transfer claims, and what are the key provisions, and what other risks should be carefully considered before selling a claim. So without further ado, I'll pass it over to Matt, and he can start the presentation.
Sure. Thanks, Ken. So again, I'm Matt Piniella. I'm Vice President at JP Morgan, and I've spent close to the last 10 years of my career working on bankruptcy claims. And it's a market that's not usually very well understood because it's not a very transparent market. The asset class is not standardized. They're all private transactions, so there's just not a lot of transparency with the market, within the market. Yet it's inevitable that most credit executives at some point will be left with a claim against a counterparty that is in bankruptcy and you're going to be you're going to have a situation where you need to determine what to do with that claim, whether to hold it or whether to consider selling that claim at some point. And just to give you a sense of what I'll be covering today, I'm first going to talk about the current bankruptcy landscape, our expectations for future default rates, the bankruptcy claims market, what claims are, how the market functions, the typical risks associated with claims, the key terms within the assignment agreement, and some of the most important considerations when selling claims. So first, the three main forms of bankruptcy. The first is the Chapter 7 bankruptcy. Then there's two other forms that you'll most commonly see, the Chapter 11 and the Chapter 13. Chapter 7 bankruptcies are when there's not an ongoing business. The trustee will gather the assets of the business and sell them to satisfy or attempt to satisfy the claims of the company's creditors. Skipping to the bottom, Chapter 13, those are bankruptcies involving a individual where the trustee will develop a repayment plan. It pauses the collection efforts of creditors, and they try and develop a plan to best satisfy the claims of the creditors based on the assets that are available. Chapter 11 is the form of bankruptcy that we're going to be focused on. It's the type of bankruptcy you typically think about when you consider companies in bankruptcy. And the idea is typically a company doesn't have the liquidity to satisfy the claims of its creditors, or there's a need to restructure the balance sheet to better facilitate the business and hopefully provide compensation to the company's creditors. So where are we in the current bankruptcy cycle? Since 2010, default rates have remained at historic lows. At the end of 2014, the global speculative grade default rate was at 1.42%, In the U.S., that default rate was at 1.6%, and to just give you a sense, the long-term average is about 3.8%, so we're well below that long-term average, and we have been for a few years now. 2014 default rates were below their long-term average across all industries, so this isn't unique to certain industries. This is across the entire spectrum. We're at exceptionally low default levels. The graph at the bottom, the chart at the bottom rather, just provides a little bit of a visual in terms of how cyclical the bankruptcy cycle is. And you can see where we are right now relative to the peaks in the early 2000s and in 2008 and 2009. Corporate earnings and the credit and their associated credit metrics are extremely strong right now. A lot going on this slide, but just to give you a quick overview. On the top left, you can see that corporate revenues and EBITDA have both been growing since 2012. On the top right, just to give you a sense that EBITDA margins, and this is specific to high-yield companies, EBITDA margins are in the 14 to 16% range. Interest coverage ratios are above 4% on average, and leverage ratios are trending a bit higher for high-yield companies, which is something to keep an eye on, but they're still considered to be fairly reasonable right now. Because of those strong underlying fundamentals, as well as just a global hunt for yield among investors, these companies have been, high-yield companies have been able to easily raise cash, and what they've done with that cash is to refinance near-term maturities. So on the bottom, there's a chart just giving you a sense of new issue volumes, and so new issues of high-yield bonds and institutional loans are up significantly. In 2013, companies raised well over $1 billion of high-yield bonds and institutional loans. And in the top right, you can see that the maturity wall for these companies is 2017, 2018, or later on average. There's just not a lot of debt that's maturing in 2015 and 2016. So companies are really not going to have a lot of issues in terms of creditors, bondholders, lenders needing to be repaid. So even companies whose underlying business is not performing that well, there's not going to be that same catalyst that would typically push a company into bankruptcy. And just a few statistics on that. Debt maturing through 2016 has been reduced by $190 billion, and over the next 2 or 3 years, only 5 and 10.9% of the $2.6 trillion leveraged credit market will mature. And to give you some context, in 2010, 10.1 and 21.2% of the market was coming due in 2 and 3 years. So we're at half of those levels right now. So with the market willing to refinance high-yield companies' debt, we expect default rates to remain very low for the next 1 to 2 years. In 2015, high-yield bond default rates are expected to be 1.5%, and in 2016, that rate's going to increase, but still only 3%. And again, that's versus a long-term average of 3.8%. And with all of this, obviously, the caveat is that this is barring the unforeseen event that could cause credit markets to become uncooperative. The assumption here is that companies are able to continue to roll their debt, and even those 2015 and 2016 maturities are probably less problematic than they would be if credit markets froze up or became less receptive to new issue offerings. So on the next slide, what is a bankruptcy claim? So Section 1015 of the Bankruptcy Code defines a claim as a right to payment or right to equitable remedy for breach of performance if such breach gives rise to a payment. So really, a bankruptcy claim is the right to some form of compensation based on debtor's available assets and the priority of a creditor's claim. And the main types of claims are trade claims, lease rejection claims, deficiency claims, and contract rejection claims. So trade claims are probably the most common form of bankruptcy claim. These are claims that arise when a vendor is shipping on credit and they're providing either a good or a service, expecting to be paid in 60 or 90 days, and their counterparty filed for bankruptcy. So they now have either a general unsecured claim or, depending on when that claim was created, potentially a reclamation or administrative claim. And I'll go into a little more detail later on what the difference is between those three types of claims, but they're all a type of trade claim. Lease rejection claims are basically what they sound like. When a company files for bankruptcy, if it has leases, so think a retailer that has a number of leases for different locations, they have the option of rejecting those leases. So usually if a retailer is paying above market lease payments, they'll choose to reject or restructure that lease. And creditors, who are usually landlords, will have an unsecured claim against that debtor, which is usually created based on a formula, which is the greater of 1 year's rent or 15%, and in either case it's not to exceed 3 years of rent payments. Deficiency claims are when secured creditors, so usually lenders that lend against assets of the company, when the assets are actually worth less than the original loan, that shortfall in value would be considered a deficiency claim, and it's another type of unsecured claim akin to a lease rejection or trade claim. And contract rejection claims, similar to the lease rejection claims, these are other forms of contracts that the debtor has the option of rejecting in bankruptcy. And those can sometimes be rail contracts or other financial agreements. In the case of Lehman Brothers, we saw a number of interest rate swaps where creditors actually rejected those and were left with unsecured claims. So within the bankruptcy claims market, it's difficult to come by hard statistics because, as I mentioned before, claims are traded privately. Claims are not standardized. So the terms that they trade on, the claims themselves, are not standard, so it's hard to make comparisons across the market. However, there was a Harvard working paper that was done a few years ago that pulled together a lot of information, and it's a few years old, but I think it's still helpful in just getting a sense for the market and really some of the reasons that a market exists for these claims. I'm just going to highlight a few. There's a lot going on this slide, but on the bottom left, you can see that general unsecured claims usually end up with equity in a reorganized debtor in almost 20% of bankruptcies, and oftentimes creditors, let's say you were a vendor, you're not in the business necessarily of holding equity in a reorganized company. You want cash so that you can funnel that into your day-to-day business and move on with your life. In the center bottom, 80% of bankruptcies are not pre-packs. So what that means is in a pre-pack, the debtor and creditors have the general terms of the reorganization already worked out. In 80% of the cases, though, that hasn't happened, and that's what's called a free-fall bankruptcy. Within a free-fall bankruptcy, there's a few issues, one of them being it's going to take more time for the reorganization to happen. There's value leakage, and what that means is a lot of the debtor's assets, rather than being paid out to creditors, are going to go to professionals such as lawyers and financial advisors, rather than, again, going to creditors to repay those claims.
Have you seen a trend or a change in that? The pre-pack is becoming more prevalent?
So now, in this part of the cycle, again, when we have a lot of lenders that are willing to refinance debt, even when a company is heading towards bankruptcy, we've seen a trend towards coming together with the lenders themselves and figuring out a plan before the company goes in. And what's usually needed is new money, and these creditors are more willing to do that, just given that there's a lot of money with very low yields in the market. They're willing to put in new money in exchange for some reorganized debt or equity in the company. So we have seen a trend towards more pre-pack filings of late, and that will change at some point. But right now, it's probably skewed more towards higher than 20% of filings.
That'll take care of that.
And then just the last thing that's probably interesting on this page is of the companies that file for Chapter 11 bankruptcy, almost 80% again are not sold to a strategic buyer or financial buyer. They're liquidated or reorganized. And again, that usually means it's going to be a lengthier process. If the company is liquidated, assets are being sold in a fire sale, so there's less value available for creditors. And all of these, again, play into the idea that if you weren't intending to hold this claim, you're not a secondary buyer, you're probably going to be interested in monetizing that claim if you can do it at on an attractive basis. And then on the next page, it's just these slides just give a little bit of insight into who the typical players are in the bankruptcy claims market. On the right, you get a sense of the financial institutions that are involved. Just to highlight a few: banks, private equity funds, hedge funds, and asset managers. And then in 95% of Chapter 11 bankruptcies that were studied in this working paper, corporates held claims in 96% of them. And again, these are probably the typical people that are going to hold claims and not want to, or be interested in monetizing them, or at least exploring that possibility. So with most distressed assets, claims included, asset pricing is usually very volatile. Usually in a reorganization, the ultimate value is going to be based on investors trying to figure out what the value of a company is. And when they're doing that, they're looking at EBITDA or earnings and extrapolating that out over many years. And depending on what can happen over the course of the bankruptcy, those assumptions can change very rapidly. Oftentimes, court rulings, if there's litigation involved, can greatly change investors' views on what the value of the company is or what their future earning prospects look like. And there's a number of stakeholders that are all vying for a better payout or a better portion of the assets that are going to be negotiating. So as each of these factors plays out over the course of the bankruptcy, you can see a lot of movement in price, more so than you would typically see in the bond market. So Linens and Things is one of the cases where we actually have pretty good data on pricing moves because the recoveries were a function of bond pricing. So we saw Linens and Things when they filed, the bonds were trading at 45 and ultimately recovered only 4 points. And in the meantime, we saw swings of up to 10 points on a weekly basis. And claims themselves trade at a discount to bonds. So even if the bonds are what's called pari passu, even if they're entitled to the same level of recovery, claims are going to trade at a discount. The main reasons for that are that claims are generally less liquid, and I'll get into what the claims transactions actually look like, but they can be fairly time-consuming versus a bond that you can call your bank and purchase, and you'll have it in your account in 3 days. There's also sometimes entity risk, meaning that bonds can have claims on different entities than the actual bankruptcy claims do. Claims require a little bit more effort to do the due diligence on the underlying claim and understand what you're buying. Bonds sometimes are due interest that's not available for claims. And again, trading technicals, usually you have a lot more buyers of bonds because it's something that's more familiar and it's a better known asset class. So for all those reasons, claims typically trade at a slight discount to bonds. So again, going through, depending on when a claim is created, claims can receive very different treatment during the bankruptcy process. And I'll go through kind of different stages of bankruptcy claims. So the majority of claims are going to be considered general unsecured claims. These are claims usually, again, for either goods or services that were provided on credit. Any claims that were created outside of 45 days from the bankruptcy filing, where the creditor holds no security or collateral, these are just going to be considered general unsecured claims. Inside of that 45 days, but not within 20 days of the bankruptcy filing, you may have a reclamation claim. And these are for vendors that are actually shipping goods, so not services, actual hard goods that are shipped within 21 and 45 days of the bankruptcy filing. These are considered reclamation claims, and the creditor may have the ability to claim those goods back and actually receive those from the debtor. So these are are considered superior to general unsecured claims because you may have the ability to just get your merchandise back and hopefully sell it for 100-cent dollars rather than waiting on the bankruptcy to unfold and take whatever sort of value is ultimately paid out. And then any goods or services that are provided within 20 days of the bankruptcy filing are automatically given administrative status. And these administrative claims have to be paid out in full in order for a debtor to emerge from bankruptcy. So if you have provided goods within 20 days, you're virtually guaranteed to be paid out 100 cents on the dollar, assuming the debtor is going to emerge from bankruptcy at some point. So once the bankruptcy has actually occurred and these claims have been created, there's a few stages, or at least a few buckets, in terms of how investors look at these claims. The first is claims that have been filed against the debtor, but the debtor has not recognized them. So shortly after filing bankruptcy, a debtor is compelled to file what's called the Schedule of Assets and Liabilities, and it's their best estimate in terms of what they believe their creditors are owed. Before that's filed, any claims are considered pre-scheduled. So you may file a claim for $1 million against a company XYZ. That's your view on what you're owed. Until the company files their schedules, investors don't know whether the debtor actually agrees with that amount. So you may say you're owed $1 million. The debtor may say, actually, some of these goods were defective. Our view is that you're only owed $900,000. So while claims are pre-scheduled, it's a little more challenging to determine whether that claim is actually $1 million or $900,000 or some other number. Scheduled claims are claims that are actually showing up on the debtor's list of claims. These are when most claims trade. These claims are considered allowed claims unless there's an objection at some point, but as soon as they show up on the schedule, the debtor agrees to that amount, so investors can be a lot more certain that the claim is the amount that you're alleging it is. And allowed claims, these are claims that have been formally blessed by the bankruptcy court. So the creditor, the debtor agree on the amount, and the bankruptcy court has signed off on it, and they're not subject to any further dispute. So these are the claims that, you know, they're considered the quote-unquote cleanest claims because everyone is in agreement and the amount has been finalized. So on the next slide, I've just provided kind of a visual, and there's a little bit going on here, but it's a basic framework for how the transaction works. So the first step is that the client, the vendor, is providing goods or services via their pre-petition relationship with the debtor, and then the debtor would file for bankruptcy, and in exchange the client obviously is granted a claim against that debtor. Once the client makes a decision that they want to sell that claim, they would assign it to some sort of financial institution, and I'll better define who those players are a bit later, but they would assign that claim in exchange for immediate payment. And then the financial institution that purchased the claim then basically stands in the shoes of that original creditor. They would have that claim against the debtor, and they would take the risk of whatever recoveries come out of the bankruptcy. And they would take the risk that those claims could take a lot longer than anticipated, that they may be higher or lower than the purchase price, and maybe in the form of cash or equity or some sort of rights offering. Those are the risks that the buyer will take. And then ultimately, the bankruptcy court is the one that will determine whether that claim will be allowed or disallowed based on any sort of objections as to the claim amount. And so, while it sounds simple that the claim is just assigned to the buyer, it's usually a fairly cumbersome process. And I think this is the aspect that is most challenging for creditors to get comfortable with, is there's an informational disadvantage between buyer and seller. Usually buyers in this market understand the actual asset very well, and they've been buying these claims for quite some time. It's kind of a clubby market, and normally if you're a vendor, you don't often hold claims, so you're probably not familiar with the process, but I'll go through it in a little bit more detail. So the first step is typically that the buyer reaches out to the seller, and they'll provide some sort of kind of soft bid for the claim. and then the two will negotiate around price. Usually up front, the very basic details are negotiated, so the price and the form of the sale, and that's usually confirmed via an oral agreement. So the two parties will agree on price and the actual type of claim that's being sold. Usually that's memorialized in a confirm. So this is basically a short letter that has just the most basic terms of the sale, and it just locks in both parties until a more robust agreement can finalize the transaction. In between the confirmation and the actual formal agreement, the assignment agreement, the buyer will do due diligence on the claim. And the objective here is just to verify what the actual claim amount is going to be. So going back to the previous example, if the vendor is saying they have a $1 million claim and it's not yet scheduled, the investor wants to make sure that that claim is for $1 million. They want to avoid the situation where they purchase the claim and they're funding on a $1 million claim, and ultimately the claim can be objected to and might be reduced to only $900,000. So in order to get a better sense for what that real claim amount is, they're going to first request a proof of claim, and that's what any creditor needs to file right after the bankruptcy date to allege or to assert their claim amount. So that's filed with the debtor, usually via what's known as a claims agent, and they're basically an administrative functionary for the bankruptcy court that aggregates these proofs of claim and tracks all of them for the court. The investor will also want to see invoices, purchase orders, any contracts with the debtor, basically all the information that would have governed the pre-petition relationship and outlined the goods or services that were provided prior to bankruptcy. If the claim has already been allowed, so this would be kind of a later stage sale, there would be an allowance order or some sort of settlement agreement outlining the agreed to claim amount, and that would obviously be hugely relevant. So the agreement, the most important agreement in this whole process is the assignment of claim agreement. So while the confirm lays out just the basic terms, the assignment agreement is the governing document signed by the original creditor and the purchaser of those claims, and it lays out all of the representations that the seller would make about the validity of the claim, and it basically accounts for any scenarios down the line that may arise in what each party's responsibilities are in any of those scenarios. And I'll go through what those typical scenarios are and what those reps and warranties are in a little bit when I go into more detail on the assignment agreement. Once the assignment agreement is signed, then the buyer funds the seller for that claim. Typically, this is done via a wire transfer, and it usually happens within 1 or 2 days after the assignment agreement being finalized. And then the last step is that the buyer usually files what's known as a 3001E transfer notice. And this is filed with the claims agent, the administrative functionary for the bankruptcy court, and it notifies the court that the buyer is the new holder of that claim. So at any point in the future, the debtor makes any sort of distributions or grants reorganized equity to its creditors, it goes to the right place. It goes to the buyer rather than the original holder of that claim. And the entire process for selling a claim, it's widely variable. That's a question we often get is, well, how long does the process take? And we've done transactions that happen in 3 or 4 days, and we've done some that, due to negotiating over the terms of the assignment agreement or trying to verify the actual claim amount, can take weeks. So it comes down to how complicated is the claim, how well organized is the information that outlines the claim, and how quickly can both parties agree to the terms of the assignment agreement. But to the extent that both parties can move quickly on those points, the entire process can be done in as little as a week. So again, I've touched on this a little bit, but the main sellers, the main parties that are interested in disposing of their claim